For more on the latest move, let's now welcome in Ahmed Riesgo, Insigneo Chief Investment Officer. Ahmed, it's good to see you. So we were just talking about that PCE report we got, Ahmed. Obviously, investors pleased with what they saw. I'm curious what you made of it, Ahmed, and whether you think it gives the Fed room now and the cover to cut in September.
Look, so we certainly think the Fed's going to cut in September. I mean, the market's also telling you that they're betting very heavily on that. In fact, the market is starting to price in potentially more than 25 basis point rate cut in September. We don't think it's going to go that far. We think there'll be one. But really, we think the Fed should have been cutting rates already. And our fear is that while we are in a bit of a Goldilocks period right now, where we're seeing lower inflation and weak, but not too weak growth, so in a sense, bad news is good news for the markets. We think eventually what's going to happen is that bad news is going to become just bad news for the market. We do feel that there are higher risks of recession that are currently being reflected into asset prices, and we think as the year winds down and we go heading to the second half of the year, some of those risks are going to start resurfacing.
As you point out, that is not the consensus view at this point, right? Most people seem to have bought into this idea of the soft landing or that there's not going to be a recession. I know one of the measures you're looking at is just typically how long it takes for us to enter a recession after the Fed not begins cutting, but begins raising the beginning of its rate increase cycle. And looking back, the median is 24 months. This time around, we're above that. Now, there have been other times, as you look at this graphic here, we're on the right side, so we haven't entered the recession as of yet. 2008 was longer than 24 months, and some of the other instances have been. But what do you think are the dynamics here that would push that you think are pushing us in that direction?
Look, it's a cliche, but it's true. I mean, monetary policy does operate with long and variable lags. As you pointed out, and as I pointed out on that chart, it's the average is 24 months, or I should say the median is 24 months. We're right now at month 28. So it's been a while since the Fed started hiking rates, but it's not that much of an anomaly for it to take a long time. Remember that what matters for consumers is real rates in the economy, not just the Fed funds rate. So a lot of times it takes a while for those to trickle down and actually start having an impact on people's wallets, on loan balances, and the like. It works in reverse as well, right? The Fed's going to start cutting rates now in September, precisely for that same reason. We don't think it's going to be enough or have happened soon enough for it to prevent that recession, which we ultimately think we're due for, sometime by the end of this year, beginning of next year. It's hard to obviously pinpoint exactly when that's going to begin.
So, Ahmed, I take your point about lags in monetary policy, but I'm just curious, what economic data are you seeing right now? What metrics that gives you reason to think we could slip into a downturn? Are there certain cracks you're seeing in the labor market, for example?
Yeah, so that's a huge one. We're seeing cracks in the labor market, specifically when it comes to labor demand. Now, the flip side of that, and what the sort of counter argument to mine is, well, the labor market's has finally rebalanced. The trouble that we've seen is that historically, once the unemployment rate begins this sort of slow ascent, and we're very close to triggering the SOM rule, which I know has been brought up several times. It invariably, shoots up from there because it's positive feedback loops. People lose their jobs, they cut spending, and the cycle begins. So we're seeing dangers in the labor market that are pointing us in that direction. But we're also seeing a lot of weakness in the lower income segments of the economy. This is something that we're seeing in the economic data. Consumer credit debt is skyrocketing. We're seeing delinquencies starting to rise. But we're also seeing that reflected in these earnings calls, right? A company like Visa said, yes, we're seeing stabilization among higher income groups, but lower income groups are starting to feel the pinch and are starting to cut back spending. So we're starting to see pressures in those lower income segments. That's a warning sign for us.
So, Ahmed, if you're correct and we're headed towards recession, what does that mean for equities and your strategy?
Yeah, so we think, new money should not be deployed in the equity market right now, or if it is going to be deployed in the equity market, it should be deployed in highly defensive sectors like utilities, for example. That's one sector that we like quite a bit. It's actually performed very well. We think it's an interesting way to play the defensive side, but also as a proxy to the AI trade, because we're seeing like electricity generation is for the first time 10 or 15 years in this country, a growth sector. But we think the most attractive place to deploy money right now is in long duration treasuries and gold specifically as well, right? We still think gold is a very attractive asset to put new money into.
Ahmed, it's election season. I have to ask you what kind of questions you're getting right now from your clients, and what are you telling them?
Yeah, as you can imagine, it's been quite a whirlwind. I was actually giving a talk in Mexico last week to some of our clients down there, and I joked with them that I was a few millimeters from really having to change my speech because it's just such a fast-moving cycle. So many things are happening. There's still 4 months until the election. That is an eternity in this cycle. I will tell you this. I don't think the race has changed much from the presidency side. And we're seeing that in the prediction markets. The prediction markets really haven't budged all that much. They're roughly still showing Trump with a 60% chance of winning the presidency and Kamala Harris sitting at around 40%. We think those odds are rational at this moment. Where we have seen a difference is in the House races. And we think this is part of the reason why the Democrats made the move, because of the down ballot effects. I think there is going to be greater turnout and greater enthusiasm for Kamala than there was for Biden, and we think that's going to help down ballot in the House races. So the House is I would say a bit of a toss-up right now, slightly favoring the Democrats. The presidency is moderately favoring Donald Trump, and the Senate though is overwhelmingly favoring the Republicans right now. If you look at the betting markets, those odds are sitting at around 72, 73%.